On your screen are trailing return charts of two types of funds, flexi-cap funds and category X. Now over the last 3 years, while flexi-cap funds have delivered 20.2% returns, category X has returned 27.1%. And over the last 5 years, category X is ahead by about 3 percentage points. Category X is almost like flexi-cap funds but is relatively underexplored. Chances are you haven't heard of it. It has just 9 funds as opposed to 38 funds in the flexi-cap category. Now, as of January 2024, the total AUM of the funds belonging to category X is just around 23,000 crores, as against the giant AUM of 3.34 lakh crore of flexi-cap funds. That's less than a tenth. And the largest fund in category X has an AUM of around 6,400 crores. The largest fund in flexi-cap category is the Parag Parikh Flexi-cap Fund, and it has assets over 55,000 crores. So, category X has largely remained under the radar. Thanks to the lukewarm response given by the investors, even AMCs haven't bothered much about launching funds. But the question is this: can this category be a better substitute for flexi-cap funds? And that's what we will explore in this video. Hello and welcome to ED Money's YouTube channel. The category of funds that I'm talking about is dividend yield funds. In this video, we will compare dividend yield funds, a largely unknown category, with the most popular equity category, that is flexi-cap funds. And from the trailing returns data, we know that dividend yield funds have done better than flexi-cap funds. So are dividend yield funds really a hidden gem? We will try to find that answer in this video. But before we begin, a quick update. You are watching this video on ET Money's English YouTube channel. हमारा एक हिंदी चैनल भी है जहाँ पे आप सारी वीडियोस हिंदी में देख सकते हैं. And if you are or know somebody who wants to understand the basics of finance in a quick and easy way, we have a channel called 5 Minute Finance. Do check them out. Alright, let's begin with a quick introduction to dividend yield funds. So let me start with what they are not. Their name may seem to suggest that they pay dividends of some kind, but that's not the case. Of course, if you were to opt for the IDCW variant, that's a different case. But the word dividend in the name of these funds doesn't mean that you will get dividend of some kind. Now, as per SEBI mandate, dividend yield funds must predominantly invest in dividend yielding stocks. And that's it. There is no specific requirement for the dividend size or any particular way to select dividend payout stocks. So funds in this category are free to pick stocks as they wish, provided they are dividend yielding. Now, on the BSE, as of February 27, 2024, there are about 1,492 stocks with a dividend yield of some kind. Of these 1,492 stocks, 431 stocks have a dividend yield of more than 1%, and 174 stocks have a dividend yield of more than 2%. So the investment universe of dividend yielding funds is quite rich, as good as that for flexi-cap funds. And that's what makes them flexi-cap like. Okay, so there are 9 funds in the dividend yield category. The largest one, the SBI Dividend Yield Fund, is just 11 months old. But 6 out of these 9 funds are more than 5 years old. And as I said, these funds have their own investment styles for dividend yielding stocks. For instance, SBI Dividend Yield Fund aims to invest at least 65% of its asset in dividend yielding companies. However, it is also open to investing in companies with lower dividend yields but a growing dividend payout. On the other hand, the HDFC Dividend Yield Fund is open to investing in companies that choose to do a buyback in addition to or as an alternative to dividends. It considers stocks that have paid dividend or done a buyback in at least one of the preceding 3 years. The UTI Dividend Yield Fund considers dividend yield as a primary filter and goes on to analyze other fundamental factors such as cash flow generation, management quality, and earnings growth. All in all, dividend yield funds use dividends as one of their primary selection criteria but don't limit themselves to it. It is often a starting point. Like any other plain vanilla fund, they go on to analyze companies on fundamental attributes. And that's what gives them a flexi-cap spirit. Now, one term that frequently occurs here is dividend yield. If you aren't sure what it is, let me quickly explain. The dividend yield is calculated by dividing the dividend paid by a company by its stock price. For instance, if a company has given a dividend of 100 in FY24 and its current stock price is 10,000, its dividend yield is 1%. The dividend yield will change every day as the stock price moves. So if the company's stock price becomes 12,000 and the dividend stays at 100, the dividend yield will come down to 0.83%. And if the stock price falls to 8,000, it'll rise to 1.25%. Now, another related term is dividend payout ratio. The dividend payout ratio is calculated by dividing the dividend by the net profit. So if the total dividend paid was 100 crores and the net profit is 1000 crores, the dividend payout ratio is 10%. In other words, the company has distributed 10% of its profits via dividends to its shareholders. Unlike dividend yield, this ratio doesn't change daily. It will change only when the company announces its next profit or dividend figures. Okay, so this was some technical stuff about these funds. A logical question arises at this point. What's the idea behind dividend yield funds? What are these funds supposed to achieve by focusing on dividend yielding stocks? Well, the logic behind this is that dividend paying companies are considered to be more stable. For a company to regularly pay dividends, it should have sufficient profits. So dividends become an indicator of the stability and strength of the business. Dividend paying companies are also believed to be more resilient to market and economic downturns. Further, holding good dividend paying companies for the long term can add significantly to the investors' returns. For instance, let's say a company has a net profit of 100 crore. It has a dividend payout ratio of 10% and it has maintained it over the years. Its profits are increasing at the rate of 12%. The number of shares is 1 crore and the stock price is growing at the rate of 15%. So in year 1, the company paid a dividend of 10 rupees per share. Since the stock price was 500 at the time, the dividend yield is 2%. Now, in year 10, the company's dividend has risen to 28 rupees per share. The stock price now is 1759. So the dividend yield is 1.6%, which is less than 2% of the start. But wait, if you bought this stock in year 1 at 500 rupees, your dividend yield is 28 divided by 500, that's 5.6%. So by holding the stock for the long term, you are getting a 5.6% return in year 10 via the dividends. And if you add up all the dividends, that's 175 rupees. That's a return of 35% on your invested capital in 10 years via dividends alone. This is over and above the stock price appreciation of 15%. So dividends can not just add to your returns, they can also create magic over the long run. Of course, it requires a company to stay profitable and continue to do a good business year after year. So in a way, dividends become a proxy of good performance. And that's the idea behind the dividend yields funds. To cut a long story short, by focusing on dividends, these funds try to pick solid businesses that are less volatile amid economic and market fluctuations. But this is not to say that non-dividend paying companies are bad by default. Often, growing businesses pay little or no dividend as they require any surplus to be directed towards the company's growth. Now, some of the world's most renowned companies don't pay dividends. For instance, Alphabet, Google's parent, doesn't pay dividends. Neither does Warren Buffett's Berkshire Hathaway. Okay, this was some information about dividend yield funds. Let's now compare them with flexi-cap funds. Our regular viewers know that we are a big fan of rolling returns. That's because it's a robust, more reliable indicator of performance. Now, rolling returns mean all instances of returns for a certain period over a time horizon. So, a 5-year rolling returns over the last 10 years would take into account all 5-year return instances over the last 10 years. When all these instances are averaged, we get average 5-year rolling returns. Now, let's compare the average 3 and 5-year rolling returns of dividend yield and flexi-cap funds. Now, dividend yield funds are ahead of flexi-cap funds both in terms of average 3 and 5-year rolling returns. At about 2.5 percentage points, the outperformance is steeper for the former. If we see the annual returns, dividend yield funds have done better in recent years. In 2021 and 2023, there was a wide difference in the performance of these two categories. In the 2 years, dividend yield funds outperformed by 5.5 and 7.84% respectively. Let's also check the risk side now. Let's see the volatility of average rolling returns. To measure volatility, we use a metric called standard deviation. The higher the standard deviation, the more the volatility. Now, dividend yield funds turn out to be more volatile than their flexi-cap peers. This goes against the expectation, as one of the reasons for investing in dividend stocks is to contain volatility, but that doesn't appear to be happening. Lastly, let's see how well these funds contain the downside as compared to the flexi-cap funds. In 4 out of 7 quarters when the Nifty 50 gave negative returns, dividend yield funds did better than flexi-cap funds. Now that's decent enough. So dividend yield funds do appear to be a worthy option. They have generated better returns, albeit at higher volatility. But when seen in terms of downside protection, they have done well. The next obvious question is what's working in favor of dividend yield funds? Of course, the theory that consistently dividend paying stocks are likely to be robust businesses is there. But can there be something else? After all, such stocks would also be part of the flexi-cap funds. And we saw that the universe of dividend yield and flexi-cap funds are quite similar. So let's try to answer that question. To figure out what may be working for dividend yield funds, let's compare the market cap allocation of dividend yield funds with that of flexi-cap funds. Over the last 3 years, these funds have maintained a median large cap exposure of 62.5%. The mid and small cap exposure is 28.9%. Now, if you were to check the market cap allocation of flexi-cap funds, a similar pattern emerges. The median large cap exposure is 64.8%, which is slightly higher than that of dividend yield funds. The mid and small cap exposure is around 30%, almost the same as that of dividend yield funds. However, given the size of the flexi-cap category, it may be prudent to check the market cap allocation of the top 5 funds by the AUM. These funds are Parag Parikh Flexi-cap, HDFC Flexi-cap, Kotak Flexi-cap, UTI Flexi-cap and SBI Flexi-cap. These 5 funds have AUM ranging from 20,000 crore to 55,000 crore. Together, they have assets of more than 1.92 lakh crores. That's 58% of the total assets of the flexi-cap funds. Now, the median large cap exposure of the top 5 flexi-cap funds is higher at 66.03%. The median mid and small cap exposure is lower at 24.05%. So the large cap exposure of the top 5 flexi-cap funds has ranged from 61.63 to 69.45. On the other hand, for dividend yield funds, it has been between 52.36 and 66.84. And the mid and small cap exposure of the top 5 flexi-cap funds have ranged from 20 to 29.4%. And for the dividend yield funds, it has been between 24.7 and 36.5%. For dividend yield funds, it has been 24.7 to 35.5%. This shows that dividend yield funds are better adjusting their portfolios across market caps as against the top 5 flexi-cap funds. Now in 2021 and 2023, when dividend yield funds massively outperformed flexi-cap funds, their average large cap exposures were 57.22 and 61.6% respectively. On the other hand, the top 5 flexi-cap funds held 62.9 and 67.1% in large caps. For the top flexi-cap funds, getting deep into large caps is unavoidable thanks to large AUM. They will find it difficult to allocate higher assets to mid and small caps. So these funds can't really be too flexible, and this may be what is pulling down the returns of flexi-cap funds as a category. On the other hand, thanks to their lower AUM, dividend yield funds can be more agile. This helps them shift to mid and small caps during the bull runs and to large caps in more challenging times. Now in the last couple of years, mid and small caps have been on a tear, and this seems to have benefited the nimble-footed dividend yield funds. In an earlier video, we explored this aspect of flexi-cap funds becoming large cap-like. In this video, we had suggested 3 alternatives to investing in flexi-cap funds, including large and mid-cap and multi-cap funds. And from the analysis of this video, we can say that dividend yield funds can be another alternative as well. Now, the major advantage of dividend yield funds is their more deeply ingrained flexi-cap nature. That's not so with large and mid-cap and multi-cap funds. Large and mid-cap and multi-cap funds have mandates around their market cap allocation. Dividend yield funds are not bound by any such requirement, so they are even closer to flexi-cap funds than large and mid-cap and multi-cap funds. Plus, given the small AUMs of dividend yield funds, they have proved to be more agile, and this has likely contributed to their better performance as well. So dividend yield funds do prove to be a hidden gem and a worthy substitute to flexi-cap funds. But does it mean that you should exit your flexi-cap fund and now rush to dividend yield funds? Let's see. So is it time to shift out of flexi-cap funds and into dividend yield funds? What I have shared with you in this video is a perspective based on averages and that of category level. It doesn't automatically mean that you should exit your flexi-cap fund and invest in dividend yield funds. What you should do would depend on the actual fund in your portfolio and your investment requirements, and you are the best judge as to what you should do. In all our videos, our effort is to analyze investments from various perspectives and bring to you the results so that you can make more informed decisions. We would never want to handhold you in any action. Moreover, oftentimes there is no right or wrong answer. It's all about what suits you. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, do share it with your friends and family. I'll see you with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.